No matter where you live, mortgage interest rates are on the rise and have been for the past several weeks. But how does that impact you and your purchase plan? How do you understand the rise in rates and how it affects your monthly carrying costs? If you're looking for a better level of understanding of how the rising rates impact you and your purchase plan, this is the video for you. Hi there, it's Eirik the Expert coming to you with a fresh new look on interest rates. I know, you've heard enough, right? They were low and now they're high. I get it. But since every situation is different, and since every cloud has a silver lining, as they say, I think it's worth looking at your mortgage payment on a deeper level so you can make an informed decision on how you strategize to achieve that dream of buying a new home. Now, as a wise person once quipped, homeowners live in the monthly payments, not the purchase price. Mortgage interest rates are undoubtedly and understandably a large consideration when it comes to purchasing a new home. Until very recently, we've been experiencing historically low mortgage interest rates over the past several years. These historically low rates helped the U.S. economy recover from the 2008 financial crisis, continued through the 2010s, and remained low as we experienced a global pandemic for the last couple of years. In fact, until last month, rates on a 30-year fixed rate loan have been below 4% for the most part since October 2011, a far cry from October of 1981 when rates were a whopping 17%. But that doesn't change the fact that times have changed and buyers, and therefore sellers, are feeling the sting from the rising rates. In fact, that may be the understatement of the year, considering rates have nearly doubled from their lowest point, drastically affecting the buyer's buying power. It feels as if the property you were looking at last week just went up in price considerably. It feels as though you had to give up on square footage, amenities, or location just when you thought you had it all figured out. It feels as if the only alternative to buying less apartment is to focus on properties with lower maintenance or common charges, or by putting the purchase on hold altogether in hopes that rates will fall in the future. How it feels is incredibly important, reasonable, rational, and understandable. Okay, so you want my advice? Oh man, I was hoping you'd say yes. Before drastically changing course, panic buying or panic ditching or deciding to continue renting for another year or two, let's calculate how that increase actually affects our purchase in real dollars so we can understand how mortgage math works, then calculate the cost on a monthly basis in the short term and the overall cost over time to make sure we're making the best and most rational decision possible. We'll work it out together. Okay, for the purpose of this exercise, we'll use the current conventional 30-year fixed rate mortgage interest rate of 5% and compare it to the average rate in the spring of 2020 before COVID, which was about 3.5%, a difference of 1.5 or 1.5 points. As I mentioned, I fully acknowledge that a 1.5% increase in rates is significant, especially since it represents nearly a 50% jump in rates. But let's try to leave the increase relative to old rates out of the conversation and just focus on how that 1.5% change in mortgage interest impacts us and how we can put it into terms that will help us with our rent versus buy calculation, because that's what it's all about. Since there will be a true financial cost to a higher rate, it's best to use dollars rather than decimals by calculating our exact monthly mortgage payment, which consists of both principal and interest, also known as P&I. For you math fans out there, the equation to figure out your monthly mortgage payment looks like this. Now, unfortunately, most of you are not math fans and would rather not try to figure out what L represents, let alone 1 plus C or N minus 1, which is why many of us end the exercise right here. Well, I have great news for all you arithmophobes out there. There's a tool created by your math-loving buddies called the Mortgage Amortization Factor Chart, and it may help stop your head from spinning with painful memories of brackets, balancing equations, and high school calculus. The Mortgage Amortization Factor Chart does most of the heavy lifting for us by charting exactly what our monthly mortgage payment is per $1,000 borrowed for several different mortgage terms. Simply scroll down the rate column until you find your rate, then follow that row right to the correct mortgage term. For example, the mortgage amortization factor on a 3.5% interest rate on a 30-year fixed rate mortgage is 4.49. How does that translate into dollars? Easy. The table shows us that for every $1,000 you borrow, you pay $4.49 per month for 30 years, or until you sell or refinance your loan, both of which are far more likely than living out the entire term of the loan in that apartment or house. Of course, calculating our mortgage payment in the $1,000 increments doesn't make a lot of sense unless we're buying property in Iowa in the 1830s. Therefore, I like to use $100,000 increments, which thankfully is an easy change to make. All we have to do is move the decimal point to the right 2 places from $4.49 to $449. So for each $100,000 I borrow, it costs me $449 a month for 30 years. Now that we've discovered a quick and easy way to calculate our monthly mortgage payment, courtesy of those who like math, thank you, let's figure out how the change in rate will affect us in real dollars by comparing our rates of 3.5 and 5%. As I mentioned, a difference of 1.5 or 1.5%. Using our mortgage factor table, we know the following. A 3.5% interest rate equals $449 per $100,000 borrowed. A 5% interest rate is $537 per $100,000 borrowed. The difference between the two mortgage factors is 0.88, 5.37 minus 4.49. Move the decimal over 2 spots and you get 88. So for every $100,000 you borrow, you're paying an extra $88 a month for your monthly mortgage payment. If you're purchasing a $1 million apartment or home and plan to finance 80% of the purchase price, $800,000, you'll pay an additional $704 a month. Now that's certainly not insignificant, but let's try to add some perspective when it comes to the overall deal and why a 1.5% jump in rates shouldn't necessarily dissuade you from purchasing an apartment. Here are 6 points for you to consider. Number 1, as I mentioned, $704 is not an insignificant amount, especially on a monthly basis. That's $8,448 a year after all. However, keep in mind that the overall mortgage payment on a loan of $800,000 at 3.5% is $3,592 a month. Add a hypothetical but reasonable monthly maintenance payment of $1,500 a month, and our total pre-tax carrying cost figure is $5,092 a month. So adding $704 to that pre-tax number is about 13%. Keep that in mind for a future point. Number 2, we don't live or purchase in a vacuum. So if you're going to live in New York City or whatever city you live in and don't have the benefit of rent control or a wealthy family member, you're destined to either rent an apartment or own one. So despite the fact that rates are higher than they were last year and last month, they're still at historic lows, and more relevant to what's happening currently, most analysts predict that rates will continue to rise over the next several months. So, although loss aversion is causing buyers to focus on what they no longer have or what they lost, unless you continue to give up on your purchase goals for the foreseeable future, you have more to lose by continuing to wait out the inflationary period we're in right now. Number 3, rising rents. All right, a few points here. As I mentioned, you have to live somewhere, and that place will likely have at least a few walls. In our example of $1 million purchase, the percentage increase of the monthly cost pre-tax of an apartment is about 13%. Remember that? Well, wouldn't you know it, rent prices in New York City have risen over 10% in the last year, and some say up to 14 or 15%. And that's just in the last year. What happens next year? I don't know. But what I do know is that my monthly payment on my 30-year fixed rate mortgage will never change. It remains constant and takes me out of that annual should I stay or should I go now decision. Bottom line, the rent versus buy calculation still favors buying if you have A, the down payment and post-closing reserves necessary to purchase, B, you have the time to complete the purchase without becoming homeless and confused, and C, you plan to hold the property for more than just a few years to allow for appreciation and the mitigation of frictional costs of purchasing, blah, blah, blah. I'll add this as an addendum to the point on the rent versus buy. Building equity. It's an old story, but an important one. Over the course of the first 5 years of your mortgage, about $1,000 of your monthly mortgage payment in our example is principal, while the rest is interest. So rather than handing that $1,000 a month to your landlord, you stand to build or gain about $12,000 a year in equity. And if you're still there after 5 years, I have even better news. Your ratio of principal to interest increases to about $1,500 of principal each month by the end of year 10. And it keeps growing from there because the P&I curve looks like a playground slide. It's shallow at the top, steep in the middle, and shallow at the end. Whee! Number 4, refinancing or selling in 5 to 7 years. Although you have the benefit of gaining a greater percentage of equity per month over time, the reality is that most people do not live out the full 30-year term of their mortgage. In most cases, one of two things happens after a period of time: selling or refinancing. So do you see yourself selling in 5 years? 10? If you stay for 10, will you have an opportunity to take advantage of a lower rate in the future? More on that later. Let's take a conservative approach and assume you'll hold the apartment for 7 years. As we established above, the pre-tax monthly burden of an extra 1.5% interest rate on an $800,000 mortgage is roughly $704 a month. Therefore, the cost of that rate increase over 7 years of ownership is $59,136 on a $1 million property. That's less than 6% of the entire purchase price over 7 years. And here's the interesting thought. If you're delaying your purchase to capture a lower future rate, when do you expect that to happen? A year from now? 3? Well, if you're right about future rates going down, refinance and you'll mitigate your loss. The pain of a high rate is temporary if the rate comes down. If rates continue to rise, well, each day you wait puts you at an increased loss. Number 5, appreciation. Look, when you sell or refinance and the equity you build over time doesn't even take into consideration the potential appreciation of the property over the next 7 years or 10 years. This is also difficult to predict, I understand, but what is the appreciation cost of waiting? Something to think about. Number 6, moderating markets. This refers to the idea of less severe over-ask bids in highest and best. If you're in a tight market and a market where the average over-ask is 10 to 15% right now, well, that's predicted to fall to a more balanced average of 5 to 7%. If you're in a market where over-ask bids are 30 to 40%, well, that's likely to fall to 15 or 20%. As much as this is phantom savings for you as a buyer, if those predictions are true, you're talking about significant savings on your investment compared to 6 months ago when you could borrow at 3.5%. At the end of the day, whatever you decide to do in response to increasing rates, do so with a clear understanding of what it means to you and your specific goals in terms of dollars, not decimals. It'll help you put the rate increase into perspective and allow you to make a more rational decision, not a rash decision. Hey, thanks again for watching. Before you go, I got a few more videos you can check out, or you could just subscribe to my YouTube channel for upcoming content and follow me on Instagram at Eirik the Expert.